Welcome back to Investing with Confidence. I am your host, Joshua David, and we are always having a great time in studio on these beautiful, brisk days, helping our listeners with more financial literacy. And also, don't forget to subscribe to the podcast wherever you listen to podcasts, and also check it out on YouTube, Investing with Confidence. So, Al, as we get into this next topic and segment, we want to continue that discussion about the smart money, the big banks, the financial, big dollars that are out there. Now, the public thinks that, news and media and all this moves the market. It can speed the market up, but the institutions are creating turns in price, which is where supply and demand are really out of balance. And that's how the financial markets work. If there's more supply, price will go down. There's more demand, price will go up. And that's how our everyday life works as well. Think of the home prices.
Yeah.
There's more demand, price is going to continue to go up.
Yeah.
Now, talk more about in the stock market. Talk about supply and demand, how that really works in the stock market based on price charts and how the institutions are really, I guess, give more definition on supply and demand.
Yeah, well, what you mentioned, the relationship between supply and demand, more demand, price goes up, more supply, price goes down. That's a fact that really can't be argued. And fortunately for us, it's something that is consistent. And we can use that consistency to help our students to make better decisions in their investing and trading. The smart money knows what price they want to pay for something. How do they know that? How do they know what they want to pay to get into something? How do they know what they want to pay to get out of something? And sometimes that can happen the same day, or maybe a couple of days, or maybe it's months or years. Well, they know because they have access to information, to details that we don't have, because we don't have millions of dollars to spend every year to get that data and that research. They do. That's how they know the value of something, and they're patient, and they're very specific about what they want to pay for something. So we can identify in a price chart based on that institutional activity when they have taken a position or exited a position. And we show our students how to read a price chart, how to determine that. But the real key there is the institutions have so much clout, so much financial clout, that they will cause price to go up because they have increased the demand so much. They will cause price to go down because they have increased the supply so much. And if you can read that on a price chart and know, and here's the real key, I guess, let me step back for a second, is that if you are investing in a position and it might be multiple millions of dollars you're putting into that position, the institutions can't do that all at one time without driving that price so far away from what they want to pay that they may never get all of their order filled. And we go into more detail on this in these classes, but the key here, the important thing to know is that they do it in increments. They will almost never get a full order filled at one time. So if you could identify when they have taken that first part of an order, when they've made that first step, and then know that it's more than likely, high degree of accuracy or probability is going to be repeated. If you knew where the next leg of that trade was going to take place, you could be there waiting. You could have your trade set and be waiting. What it means is that price is the key. The accurate price to get into or out of something is very important. That's not what Wall Street does for their clients. Basically, they're saying it's time in the market. If you come into an advisor with a bunch of money, maybe $100,000, $200,000, they're not going to say, well, let's just hold on to that. Let's wait until we feel the price is right. What they're going to say is, let's get into the market. Let's get into the market because that's what's going to give you success. Well, because they get paid when the money goes into the market.
There you go.
And they don't want to put too much time into managing what you have. If you're sitting on money and you're waiting, and you have maybe 100 or 200 different clients that have different objectives, different risk levels, and so forth, it becomes a pretty daunting task to devote enough time to each one of those individuals. So giving your money to somebody to manage, like a mutual fund manager, is the easiest thing for them to do. But that's not what they're doing with their money. And I mentioned price being important. And the reason that the proper entry price and exit price is so important is that price determines the quality of your protection, your risk management, and your profit potential. And the price that gives you the highest probability of success with the highest profit potential and the lowest risk entry is almost always at or near the turn in price. And if you could identify when that turn in price is going to happen, that allows you to have a much better chance of having a quality trade. The turn in price almost always happens because of that huge institutional smart money activity. And that's what we identify. We identify when it happens, and there's a number of different things that we use to qualify a position, making sure that you increase the probability part of it, and you also increase the profit part of your investments.
Al, you mentioned something that I want to make sure our listeners understand. I think you said it pretty quickly. I want to make sure they caught this. You mentioned we're talking about advisors, nothing against the people or anything, but the industry is the problem, right? You mentioned everybody has a different objective, and if you're in a pool or a basket of people with the same exact strategy, well, what is your objective? What is your goal? Do you think that is their best interest? Like you said, they need to put the money in the market, then they start collecting fees. And that's why we're seeing more and more people want to understand and be educated on trading and investing, how the markets really work. And it's all determined and based off a price chart. Price does not lie. Think of it this way. You're talking about the institutions, if they're buying millions and millions of shares at one time, they can't get the same price. Right now, when institutions are buying or selling that millions and billions of dollars, they leave a footprint on a price chart, and that's where supply and demand become out of balance. And you can see that or identify potential opportunities in these markets based on that footprint. Think of it as you're walking through the snow. It's wintertime in some places and there's some snow. You walk down the street after a snowstorm, you leave a footprint. Think of that as the financial institutions. We reference the smart money pretty frequently. Now, they are not only trading stocks. They're definitely not trading mutual funds. They're selling them. They're not trading them. But we talk about these other assets every week, the futures market, the Forex market. Let's dissect and unpack those a little bit in as far as why they're so great for the average investor, because it's all about minimizing risk, but also having opportunities any time of day.
Well, and those are the two key words: opportunity and risk. And the smart money, really, that's what they are really good at. They know how to control the risk part of a trade. And let's be honest, anytime you are going to be in any kind of a financial transaction, there is a potential for risk. Well, that's something that should be managed, and that's probably the number one thing that we teach our students. And then it's the opportunity. What gives you the greatest number of opportunities to be successful? I think I had used this kind of, I'm even going to call it a stupid analogy, but of going to the state fair and going to the booth where you throw a ball at the pins, the like a bowling pins.
Yep.
You put $1 down and you get 3 balls. The person next to you puts their $1 down and they get 100 balls. Who has the greatest opportunity of being successful?
Well, they do that with more opportunities.
They have more opportunities, more things to kind of throw at those pins. Well, the same thing is true in the markets. The smart money knows that to kind of increase their opportunity of being successful, there are assets they can use to do that. And especially if they're looking for short-term returns. And understand that these institutions are trading on a daily basis. And a lot of them, the major part of their profit comes from their trading. They're not doing that by putting one portfolio together and then just letting it ride for 10 or 20 or 30 years. Doesn't that sound similar to what they're doing for you, though? That's that buy and hold strategy that Wall Street pushes, and that really is part of their business model to simplify things for them. They'll give you some ideas on a portfolio, tell you to hold on to it, don't worry about drawdowns or corrections. Well, they do. They not only worry about them, but they take advantage of them. The markets don't just go one direction. They go up, they go down, they go sideways. And there are strategies that can be used in all three directions. So some of the things that the institutions use that are different than stock and mutual fund, which is what is the go-to for their clients, are the leveraged assets like the futures market, the foreign exchange market, the options market. The smart money uses options for protection, and they use the leveraged assets to maximize the value of their capital. That leverage allows us as traders to control contracts that have a much more valuable amount than the initial investment. It's sort of like a down payment that you would make on a house when you have a mortgage. But learning how to use each of these requires the proper education. And that education, we think it's different than what most of you have access to. A lot of people listen to a seminar and think that they can learn to trade. Well, proper education requires more than just sitting through a lecture. It's more than knowledge. It's the skills to use the knowledge, and it's a repetition kind of a thing. It's a process that you go through. It's not a one size fits all kind of an event. People have different expectations, different goals. Everybody's a little bit different. That's why an education should not be just kind of, again, one size fits all. It should be customized to each individual. There may be some people listening that are just interested in increasing the amount of cash they have right now, taking care of their immediate needs, because bills always come in. Even we've gone through a kind of an economic upheaval here, where a lot of people have been out of work for a while. Well, one thing that didn't stop coming in are the bills, and they need to be paid. So a lot of people are looking for maybe some additional cash to help with things like that. Maybe some additional cash to put into their long-term retirement portfolio. And they're one of the sources that they may be looking at are the financial markets. And if that's the case, then you want to make sure that you understand how to use the proper asset at the proper time. The futures market, for example, is a great short-term trading vehicle. Has some fantastic benefits. It trades virtually 24 hours a day. It has leverage that can vary from maybe 20 to 1 to maybe 100 to 1 or so, which means every dollar has that multiple that is going to work for you. Great liquidity there, so there's no issue as far as getting into a trade or out. And then the diversification you have within that asset is probably the best of any market, any asset. You're trading the major stock markets. You can trade commodities, your favorite.
Lean
Lean
hogs.
hogs, corn, sugar, oil, gold, silver, currencies, interest rates. There are a number of things there that can be put together in a portfolio that either use correlation, use kind of inverse correlation, or have no correlation to each other. So you get the opportunity to have true diversification. The foreign exchange market, where you're looking at the difference in exchange rates between two different currencies, open 24 hours a day, 50 to 1 leverage. You have the opportunity to participate kind of on a global market. And that market being open all the time gives you opportunities at different times and gives you the opportunity to participate in a market that all the major companies really participate in.
And think about this too. I mean, if you had the opportunity to trade and invest any time of day, that gives you the opportunity. And you're talking about short-term strategies. There's many strategies that our sponsor Online Trading Academy teaches. There's short-term strategies, there's mid-term strategies, and there's long-term strategies. So whatever your objective is, there's strategies and techniques that you can learn. And Al, I want to talk about retirement coming up. We have so many listeners and viewers that want to be able to retire, and they want to understand, what can I do to protect myself, but also have more confidence going into retirement. We will be right back.